welcome and thanks for coming. You know, most everyone in the room already knows me, but if you don't, I'm David Owen. Hi. I don't know you here. I know your name. But Vincent and Peter are with another private lender in town. We're going to talk about that in the presentation, but I think you just wanted to come and get some pointers. Present a fund, right?
I want to learn from the master.
I think you're in Stallion Funding. Welcome, Vincent. We appreciate you coming. I'm not afraid of competition. I've never been afraid of competition. More competition makes the business better. So I'm excited that he's joined us. So my question to everyone is, are you on the list? Meaning, are you on the A list? And if you're not, we're going to work with you because we're inviting you today to consider being on A list. What is A-List Partners? Well, on our website, we say A-List Partners Management is a powerhouse team of real estate professionals, and I'm going to show you some of the, introduce you to some of the team today, with a great deal of knowledge, and they are working as a team, and they're offering investments into, or managing a Regulation D security that's filed with the Securities and Exchange Commission. Private funds are fast becoming a more proven alternative investment for investors. People are tired of the 1% from the banks, and they're very tired. I don't have any pennies on me. I'll give you one, Sharon. Anyway, I just got my 3 cents from Wells Fargo the other day. I was so thrilled. I went out and bought ice cream. Anyway, alternative investments are fast becoming what people are looking to. They're going into funds like Vincent, Pride of Austin, A-List Partners, other funds in the U.S. because they're getting higher yields on their investments. The banks are not paying it, they're not going to. As a matter of fact, I don't know if you read this little article that came out recently. Banks are trying very hard to take your deposits. You know, right now your deposit is considered an asset, and it's a demand deposit, and they're going to turn that into a liability. And you're asking, why would they want to put on their balance sheet as a liability? Anyone want to venture to guess?
Because we could draw it out.
Because the banks fail, they don't have to cover their liabilities. Just keep that in mind for those of you who like to hoard your money in your bank. So, you know, we're founded upon really conservative principles of underwriting standards. The same level that you've seen me do over the last, 10 years, 6 of which have been with Pride of Austin. You know, we're really going to be conservative approaching our properties. We look at it, we look at the deal, we look at the asset, and we make a determination whether we want to bring it into the portfolio or not. So you got the same level of scrutiny, if you will, that the investors in here have always been used to having with me anyway. A-List Partners REI Fund, which stands for Real Estate Investment, REI Fund 1, is the newest fund that I'm involved with. This is going to be my last fund. I guarantee you this is my last fund. But I'm going to tell you how I've structured this one, which is different than POA. You're going to love it. It's going to be a continuing fund. But this is my last hurrah. I'm getting old. It's a federal filing. It's a Rule 506 on Reg D, Rule 506B actually, which means that we don't have to scrutinize our investors. The new Rule 506C allows you to advertise on billboards. And you didn't do that, did you? Good. But the trade-off is you have to scrutinize your investors, which means that you have to give me your financial statements, your letters from your CPA, letters from your estate planner, letters from your financial planner, and your tax returns, and I have to actually verify that you are an accredited investor. Well, most Texans don't like to give a lot of information anyway. So I said, no, that's not nice. Anyway, so it's a 506 security. Accredited investors were allowed up to 35 non-accredited investors. Again, what a person puts on a subscription agreement, I have no obligation to verify. I have to tell you what makes an accredited investor, which SEC ruling is $200,000 on an individual annual income, $300,000 for a married couple. I'm not sure how that would work with people in partnerships that are not married yet. I have to ask that question. Anyway, or $1 million or more in net worth. That would be an accredited investor per the SEC. Because So the subscription agreement just asks you questions. It doesn't ask you to verify the information or to substantiate information given. Actually, you know, we had a deal once. This is interesting. It kind of threw me off. The investor said he was an accredited investor, but he worked at Walmart. And so my mind was like, how in the world is someone working for minimum wage and accredited? I thought, there must be a real estate guru or something. Now, he had made all his money in technology, and he was bored to death, and he was a greeter at Walmart. What a great way to meet people. So he was having fun, really nice guy. The management company is Alist Partners Management. We have a fixed management fee of 5% annually. I'll explain that a little more in a minute. And 30% of the net profits after the 8% preferred rate paid to investors. And I'll explain that a little more deeply shortly. Vincent's shaking his head. Do y'all do that?
Yes, but not those numbers exactly. But yeah, we have a structure.
Yeah, the reason that we do a 5% fixed fee is I'm going to explain to you what the management company is going to do, so you can say, oh, that's cheap, you know, compensation. Begins this month, or it began this month. March 1st is the date of the PPO. It's a 20-year initial term. I know you guys in Pride of Boston have heard this before. 20-year initial term, renewable 10 years beyond that. I have a feeling it's going to renew a long time, and I'll explain why when I get to the management team. All right? I don't think it's going to peter out when I walk away. Not that I would, because the management team is multi-generational, and I'm excited about who I've put together. I've really brought some talent in. So we're going to pay an 8% preferred rate of return to the investors, and then 70% of the net profits beyond that. How that works is, let's say that the fund makes, let's say the fund has $1 million in it. Then 8% of $1 million is $80,000. So that first $80,000 in profit, let's say the fund made $200,000 in profit. The first $80,000 in profit is paid out to the investors. And then there's $120,000 left. So they get 70% of that $120,000. Does it make sense? And then the management company gets 30% of the 120, not of the 200,000. So the 8% comes off the top to the investors, the management company shares in the leftover profits. 30% to 70 to the investors. So you can see, you probably will see when I start talking about some of the assets we've already started adding and how profitable that can be to an investor. Just like most private funds, this fund is owned 100% by the investors, which means that if you have $1 million fund and you have $100,000 investment, you own 10% of the fund. Now that percentage changes daily. It drives me at the wall because Ryan Schneider will send me these reports going, what percentage does someone own in the fund? And I have to calculate on this day that I signed that form, they own this percent.
I don't know.
Well, his company does. And it changes daily. So it depends on how many investors in the fund and how much each investor has in the fund and what the total investment is in the fund. So it does change daily. So if you call and say, do I own greater than 1%, I have to go calculate it at that day. So when you get your Schedule K-1s at the end of the year, that percentage is actually on there, which means on December 31st, you own that percentage of that fund. It could have changed drastically January 1. Or it could have been different on December 29th. You know, so that's really important to understand that your percentage of ownership fluctuates. It's a 2-year term commitment. I don't know very many private funds that don't require at least a 2-year term commitment. The reason for that is we need to deploy the cash. We need the cash to make income. And so we need that commitment from the investor for 2 years to make sure that it is creating income for your good and for the good of all the investors. After that, it's the same type of, if you need your money out after the 2 years, it's a 45-day notice. You can have, if we have surplus cash, we put it out the door. If we don't, the PPM states that you can get paid 25% a quarter over a year. Okay? Those are the two mechanisms of how you get your return calculated. Semi-annual distributions instead of quarterly. This is not a fund. If you need to live off your distribution, this is not a fund for you. This is a fund for you to put money in and let it grow. Okay? The income for this fund is going to be a little different than, say, most private lenders, because private lenders is, generally speaking, ordinary income, and it's treated as such on your tax returns. This is going to have a combination of ordinary income and capital gain income. So you're going to have to really work with your tax advisors to determine how you want to report that on your tax returns. I can't give you tax advice, and no one on my team will give you tax advice. I heard that right. You are not tax accountants, do not give advice. So it is a semi-annual distribution. You will get either a distribution check or you'll get a statement. Depends on whether you reinvest your distribution or you receive your distribution. Either way, you're going to get a statement in your account. If you receive your distribution and your investment is $100,000, you're going to get a statement that says, I have $100,000 in the account. I know that seems repetitive, but I've also had to work with a lot of investors who always ask, what's the statement of how much do I have in my account? Well, it's the same amount that you had before the distribution was sent. But it's hard, it's just easier to send a piece of paper, right? There's no question. You can reinvest or you can receive your distribution check. That's your choice. You cannot split it. We're not going to let you split it. However, you can change it at any time. So with a 30-day notice or less, as long as you give me notice prior to the end of a calendar semi-annual date, we can change it. So if you call a week, the last, say June 20th, and say, I would like to reinvest it as opposed to receive it, we can make it happen. We're not going to hold you to that 30-day notice. You can invest through your self-directed IRA accounts. And this is perfect for people who have Roths, because this is going to be an income-generating wealth-building fund. And as you may recall, in your Roth IRA, that profit or that income is tax-free. Right? If you don't know Ryan Schneider, just wave your hand real fast. Most of you do. This is my go-to man when it comes to self-directed IRAs. He's with self-directed IRA services. And he handles all of my accounts. Most of the investors at Pride of Austin are with him. And he'll be my go-to guy for anyone that asks me for a recommendation for Alist. They're located in Waco. They work here in Austin. Their main office is in Waco, but they set up accounts throughout the U.S.
We use it for all.
Oh, you do?
This is our county reporting.
Real quickly, when you're looking for a custodian for your IRA service or your self-directed account, there are two types. There are those that are owned by banks, okay, like this is owned by Horizon, and then there are those that are just like someone like me who's acting as a custodian. You want to be under a financial institution because when the FDIC comes in and audits Horizon Bank, they also look at the component of self-directed IRA services. So if there's anything funny going on with those custodial accounts, it's going to be caught. Whereas if you're dealing with Jake and Mo in Las Vegas, Nevada as your custodian, and there are people out there like that, you never really know what's going on with your accounts. There's no oversight. There's no one, watching. So always look for someone that is under a some sort of financial umbrella of some sort. No front-end load fees, just like Pride of Austin. No front-end load fees ever. And you'll have, as investors, you'll have real-time access to every document we have on an asset in the portfolio. Wade, raise your hand. By the way, Wade is my new James. He's never met James. And James, you're going to be watching this video, and I miss you greatly. But I had to replace you. Anyway, Wade is the new James, and he's building online access so that we can start inviting investors to view files. I want this completely transparent. I don't care if it's a handwritten note that says that from me to somebody going, I hate this property. It's got to be digitized and in the file, and you can look at it. Or I think the borrower is a complete nut. It's going to, I'm going to say that. I wouldn't write it. If you want to see the financial statements on the fund, just request it, and we'll digitize it and send it out to you. Email it, we'll digitize, send it out. It's your fund. All you got to do is request it. If you want tax returns, they're digitized and they'll be sent out. Just ask for them. Okay? All you do is ask. We're going to start auditing at the end of 2015. Those audited returns will be sent to every single investor whether you ask for it or not. Okay? You'll get a monthly newsletter from me or Wade that says this is what we're doing. We're going to keep you informed, and we're going to be very compliant and transparent with everything that we do. Nothing's hidden. Well, we're going to take our investors' money and put it to work in the strong, steady, mostly Texas real estate market. Clearly, being an 8th-generation Texan, I think the sun rises and sets here. But there are other states that have good deals. I'm not as eager to explore them because there's so much good stuff going on here in Texas, but I will look at them. And I'm going to show you some of the deals that we are looking out of state that make really good financial sense. But mostly we're going to be in Texas. So you can, if you're driving up and down 35, just a little aside, I have a management pocket in San Antonio, Austin, and then in the Dallas-Fort Worth area. So up and down 35 is where we're going to be doing our property assets. So I want to talk a little bit about the management team. I mentioned Wade being my new James. Wade has a strong background in property management on commercial real estate. He has been tracking me in Pride of Austin since we started pretty much. And he sent an email a few months ago going, hey, I'm going to be resettling in Austin. He graduated, moved on, moved up to Fort Worth. And right now I'm on my little 6-month world tour getting my traveling out of my system with my girlfriend. And when I come back, I want a job and I want to work for you. So I said, well, I don't have a position for you at Pride of Austin, but I have something else I'm working on. And so we talked about it, and Wade's agreed to come on. Behind him is Josh. Josh is he's a real estate agent here in town. He does mostly higher end properties, but Josh also represents a lot of builders. So the reason I'm bringing your attention to him is he's part of our deal club. He's going to be bringing us builders looking to either need us as an equity partner, or maybe they need us for a lender, or maybe they are weak on their asset or their liquidity, and we take that combination and go to Vincent and go, we're going to be the financial partner behind them on the equity side, they need a lender. Or we take it to Rob at Pride of Austin. In other words, we're going to be a funneler of loans if we have to be in order to help deals get, but we'll take an equity position with that builder so they can build more spec homes. But he's got a lot of builders in his back pocket, and he's very well known here in Austin as a pretty high, powerful realtor. We're happy to have him on the team. Who else is in here? Jordan's in the back hiding. He's our youngest team member. Jordan is still at school, UTSA, but he is concentrating on his BBA in real estate and marketing. And so he's going to be doing a lot of our, he's going to be doing a lot of our internet marketing. You could have wore shorts. So, anyway, he's going to be doing a lot of our internet marketing, our blogging, and then working with us in the San Antonio group to help market the properties that we'll be flipping in that area, that market. Zach, who just walked in, I'm going over the team now. Zach is in San Antonio. This is my adopted son. So he's also got a strong background in property management and real estate. That's what he does now. He's a property manager for multifamily. And so his skill set's going to help come in with property management as we build properties or flip properties in the San Antonio market. Who else is here? Well, I know Travis, he's not going to. But anyway, so we have other people. So Travis is also in San Antonio working with Zach. He's a realtor with REMAX. His mom owns a REMAX franchise. And they have a lot of opportunity to bring deal flow to us. So we're excited about that. Here in Austin, we have Jesse, who I thought would be here, but I guess he's not. Jesse currently works for Dale, but he's a he's got a passion for real estate. He's always bringing me deals in real estate, asking me if I want to participate in the deal with him. So he's one of those kinds, always out there bird dogging for properties, and we need that. Kenyon Johnson here in Austin. Kenyon just came back, I think yesterday, from being in Arizona. His dad had surgery, so we went out to help take care of his dad. Kenyon is a mortgage banker, and so one of the components that we're adding to our management team is when these funds or these properties exit our portfolio, Kenyon's going to be working with the buyer to make sure that they're going to get good financing to take that asset out of the portfolio and into their name. So it's another service that we're offering. So it's going to be seamless for an investor who wants to take one of our assets. Or if it's an end buyer, if it's a residential property, it's an end buyer, he'll be working with them. I feel more comfortable encouraging people to at least talk to him, because that way I know if that buyer is going to be real and has the wherewithal to actually take that asset. Because I don't like wasting time with buyers who think that they can buy something. I want to work with buyers who know that they can buy something. And there's a lot of people who think they can. Don't you just love it when you go out there and everyone calls themselves a real estate investor? You know, they go to some, they pay $29.99 for some audio tape, and now they're a real estate investor, and they're going to come buy all these assets from you. Then you go, okay, fine, show me what you got. There's proof in the pudding, and unfortunately they don't have any. Andy is he's a transplant to Austin from Ohio. He's got a huge number of investors in Ohio that want to bring money into the Texas market, and he's a real estate agent here in Austin. So he too is bird dogging, looking for deals for us. And then we have Jennifer, who will be back shortly. She is a property manager, a lot of experience in retail and in multifamily, as well as single family, and she's a real estate agent. So she's going to be working with us. Also bird dogging as well as helping manage properties. And then up in the North Texas area, I have my brother, who is kind of a web guru kind of guy. He's going to be working with Jennifer, and since for years people have been telling me that I should do video education, we're going to actually produce an entire series of video, how to do real estate investment. And of course, we're going to sell it, but it's free to our investors. But we are going to sell it. We're going to teach people how to do it right, you know. And we'll be having bigger classes as we build that up. Jennifer will be working with my brother, Beth. And we'll be creating our education series. I figure if I can create an education series for American Association of Private Lenders to teach lenders how to be better lenders, then surely I can teach investors how to be real investors instead of wannabe investors. So that's what we're going to be working on. So as you can see, that our management company is pretty multifaceted. And we're going to be doing a lot of different things. So our portfolio is going to consist of a lot of different things. I'm going to go through the types of assets we're going to add to the portfolio and explain to you why we're going to add those assets. We're going to buy REO properties for private lenders. May I?
Please.
Okay. Vincent is a private lender, Stallion Funding. Vincent had to foreclose on a property in San Antonio. Vincent is a lender, not a property manager. Yes, he could property manage. But you have to understand, when you take his skill set and make him manage property, his fund is not making as much money for the investors. Because the investors in his fund make money by him making money on income from the interest. So Vincent and I had lunch not too long ago. He bought it. That was nice of him. And he says, David, I have this foreclosed property. So we started talking about it. So the fund is going to assume the debt on this property. So he has interest income coming in. We're going to transfer the title to the fund. And then the fund's going to manage it, finish out the rehab. This borrower basically ran out of money. It's a half-done property. It needs, a few $1,000s. We're going to go through the numbers in a minute. But we get the upside. But the reason he's given up the upside is because he's got the income coming in and he doesn't have an REO property on his books that he has to explain to his investors. So he can literally say at the end of this quarter, my loans are all performing. which is golden when you are a private lender and you want to make your investors understand that you're solid, right? It has a lot of value. And the value to Vincent is, I'll give the upside away if you'll take off this debt away from me now, so that I can report to my investors that we are still all performing. So that's one of the things we're going to do. With all of my contacts of private lenders throughout the United States, I'm going to consider myself the cleanup guy. We're going to come in and take those assets, if they make sense, get all the upside potential. All right? We're going to do the hard work, get the upside potential, the investors benefit. Loan participation with other funds. So let's go back to Josh may have a builder, and his builder needs $800,000 to build a $2 million spec home. So maybe we don't have $800,000 in cash, and I really don't want to be a lender, and I'll tell you why in a minute. We will do it, but maybe this lender needs an equity partner to make Vincent or Rob feel comfortable making the loan. We can come in as the equity partner. And then it lowers the loan to value ratio for a private lender to pick it up and feel more comfortable with it. So we're going to do loan participation also with, okay, Vincent, I've got 400, you've got 400, they need 800, we'll participate in the loan with you. So we're going to do a lot more work like community banks used to do. They used to participate with one another, you know. But there's very few community banks now. Private lenders are the new community bank. So those are the types of assets we added to the portfolio. I love this quote from Pepper and Hamilton. They were writing for the lending exchange. Alternative lending is the asset class that some experts are predicting could grow as much as 700% in the next 5 years. This was written at the end of the last quarter, actually, of 2014. 700% growth within 5 years from private lenders. What a great alternative investment for people to consider. You can't do that through Wall Street. Fund-to-fund investing. So let's say that our fund, REI fund, is sitting on a lot of cash, and Pride of Austin, you know, would like a cash infusion. So we say, okay, we'll add to our account there. We're going to park some money there and earn that 12 whatever percent that they're paying. You know, we can do that. So fund-to-fund investing. As an example, you know, my favorite fund is out in California, Josh. He has like 130 million on the street. You've met Josh, right? He has like 130 million on the street. Sometimes he can't pull together $500,000 because he's tapped out of cash. So he'll call up and he'll go, this is what it's worth to me. I'll pay you 12%, I'll pay you 2 points on the front, and a point a month. I need that 500,000. This is what it's worth to me. Usually he does that when it's a repeat borrower that he has a long relationship with, and he doesn't want to lose that borrower to another fund. Well, 1% a month plus 12% annual plus the 2 points on the front. Can anyone add that real fast? A lot. It's a lot of return on their money. Pride of Austin has a deal like that with Josh. You know, one of the loans that Pride of Austin has is structured something similar to that. It's a cash cow, you know, and there are lenders out there willing to give away a lot of cash to keep their clients because they have that relationship with that client. Fractionalized mortgage participation. Some of the investors that have talked to Pride of Austin over the years or talked to me privately over the years, they're not comfortable. They want to own the title. They want to be owned the title. They feel comfortable doing that. So this new fund will allow us to talk to them about that. Let's say that we want to do a $800,000 property, and you know they want to come in for 50% ownership. We'll do that, and they can be fractionalized on the title, but we're going to have control. We're going to manage it. We're going to have power of attorney. We're going to have control. They just need to come to closing when we sell the asset. So that's fractionalized mortgages. First Capital does that a lot in Austin. They're pretty good at it. Abandoned properties, HOA liens, and property tax liens. Some people are afraid of those. I'm not. You know, property tax liens can be very lucrative if you really know what you're buying. Now, if you're going to buy a property tax lien and it's a structure, you're not going to be able to get in there to look at the structure, so you have to run the numbers as if you're going to have to tear the thing down. And then if the numbers work, then it's a good deal. If you think you can put a tenant in there tomorrow, it's not a good deal, because you're not going to be able to, generally speaking. Those properties are pretty distressed. We'll be looking for distressed properties, cities who have, that are having to do, if you've driven around also, you see the properties that are boarded up. Chances are the city either forced them to board it up, or the city had to board it up and now they put a fine against the property. Or if you see properties where weeds are growing up, the city eventually comes in and mows it, and they fine the owners. So we go out and we look for those properties, and then we track down the owner. A lot of times people have inherited a property, they don't even know that they own the property. So then you enlighten them, and then you say, okay, I'm willing to buy the property from you for X. But if they didn't know they own it, chances are they're going to sell it pretty cheaply, just not have to deal with it. Because property taxes may have been accruing on it, fines from the city may have been accruing on it, and they may lose it for pennies anyway. So they might as well sell it. We'll be looking for those. This is the most interesting thing that's new. Have you heard of this yet? I can just see Jim when I tell him this. He's going to go, oh, okay. Okay, HOA liens. Nevada and Florida are now super lien states for HOA liens, which means that if you have an HOA receivable and the person doesn't pay the HOA receivable, and you sue them and convert that receivable to a lien on the property, you can foreclose on that lien and wipe out the first lien holder. So by the numbers, I have a couple properties that I paid $10,000 for the HOA lien. I put in another $4,000 for each of them for legal work. So $14,000 is my net in the property. One of them has a market value of $119,000, okay? And the other one has a market value of $310,000. Now, what I have to do now is I'm working with a group, a financial group that does these all day long, and once they have foreclosed on the lien, they have to clean that title, which means they have to get the first lien holder removed from the title. I can't sell the property, but once it's foreclosed on, I can rent the property. I do have a clouded title in my name. I just don't have a clear title to sell it. I mean, they can buy with a clouded title, but if I were a person, I wouldn't buy with a clouded title. So it takes anywhere from 6 to 12 months to clear all those other liens. And guess where all that upside equity belongs? Who does it belong to? That's very interesting. 2 states are now super liens, Nevada and Florida. So we might look at things like that, but that's not going to be a big part of our portfolio, but it is an option we might want to look at. Fix and flip, distressed properties. We all know what rehab fix and flip is. We love that. You can make good money at it if you do it fast. One of my friends in town, people laugh at him because he only makes like $5,000 or $10,000 per property. Okay? And people go, that's a lot of work for $5,000 or $10,000, right? You and I would say that. Do you know how much his net worth, his net profit was last year that he had to pay taxes on? $1.1 million. He's flipping properties so fast. $5,000 or $10,000 per property is like, okay. When you multiply that by a number of properties, it's a lot of money. New construction. What we do with new construction? Inside the fund. Take Vincent, or any other private lender. They find a borrower, and they make money on the loan. They make points and interest on the loan. And then the borrower is making money on the asset, on the project. What we're saying is, instead of being a lender, why don't we make the profit on the project? So we're going to be building some things inside the fund, and all that money comes into the fund. Again, management fee and having a good management team can make it work pretty well. I'm going to show you why I'm not a real big fan of lending. This is one of the assets in the fund right now. It's a lien for 85-416. Yeah, it's at 12.5%, 2 points, and 3 points on the back side when they exit. An annualized yield of 17.5%. Great, that's good money, right? But it's not as good as what I'm going to show you. So, and then we have a second lien with personal guarantee of $100,000, and it has an annualized yield of 18%. Great, that's good, you know. And these are kinds of things that our private lenders look for all day long. But I want to do something different. Think of us as a little miniature real estate investment trust. And to be real honest with you, before I retire, we're going to convert this fund into a trust. That's the long-range plan. So that Zach and Jordan and Josh and Wade can manage this for years to come. So let's take the deal that Vincent brought to me. Don't you change your mind. There's 1,368 square feet in a 3-story structure. Okay, the guy ran out of money, he can't finish it. $435 is the acquisition cost. I agree to paying this 14%, and I should get a better deal. His estimated $57,000 for the rehab. I'm throwing in 100 because I just want to make sure that we overestimate. And our ARV of the market value is about 650 after we get it all fixed up. So our closing cost on that, 7.5%. I pay realtor title fees, all that kind of stuff. 48,750. This is our net. Now that doesn't sound like a lot of money, but if you turn it in 6 months, you got a 26.71% annualized ROI. And if you turn it in 4 months, it jumps up to 42% ROI. The faster we get in, the faster we get that asset done, the more money we make on an annualized basis. So if we do it in 4 months, we take this money, this $535,000, and we put it into something else. It takes a lot of management time to do these kind of projects. That's why we're earning 5%. Here's one that we have it under contract. You can Google it, Jim. 913 Civil. We're going to build a duplex there, twin condos. Total living square foot of 5,100. Our acquisition of the lot's 338. Our construction budget overestimated at 570. Our aftermarket value at a very underestimated $240 a foot because everything else in the neighborhood is selling for $250 to $260 a foot. But again, I like to look at things conservatively. If the numbers work on a conservative basis for me, then I'm looking at it. So our estimated closing cost on this would be $918, and this is our net annualized profit. It may take us a whole year, but still a 25% return on our money in a year. If it takes us less than a year, this percentage rate goes up. It was a real good deal. There were 2 lots together, so I went ahead and took both of them. Our living square footage is smaller. It's a smaller living square footage. In total, we're building 4 condos. But still, 144,760. What was the other number? 224? Yeah. That's a pretty good return in a year. So this one has a lower ROI because it has a smaller square foot. It's still 22.61% in a full year. Again, using conservative numbers. There's no crystal ball. Everyone who's in real estate knows that. Market could go up, go down. That's why I'm taking it at 240 a foot instead of the 260 or above on my estimation. So basically, 4 assets are in the fund or about to be in the fund. Totaling, well, profit potential is going to be substantial in those 4 assets. Or 5 assets, there's 2 ones. But this is the type of stuff that we're going to be putting in this fund. That's why it's a real estate investment fund. And so if you're ready to start higher earning, just email us, contact me, call me, text me, whatever, and ask me for a copy of the PPM and all the supporting documents, and we'll shoot that out to you for you to consider. I'd be glad to give it to you. I'll even just share it with well, you already have it. Your attorney does, or Rachel. And then after you've had an opportunity to look at the documents, you and I are going on a date. We're going to have some conversations. We're going to get to know each other. And I'm going to make sure you understand that this is a completely different type of fund than a debt fund, which is what Vincent has and what Rob is managing. It's a completely different type of fund. So we're going to look at what your needs are to make sure that you're not going to hem yourself into an investment that's going to hurt you in the future. You know, hurt meaning you need money out on a regular basis to live on.